Good afternoon, everybody. It is that time of quarter again where we start quarterly conversations, July 20th. My name is Rick Bell, and Dan Brady is our host. And it's we got quite a bit of information to chat about today. Um, First of all, first and foremost, I want to congratulate Dan on his new baby, Bennett Brady. Born, when was he born, Dan? July 7th, I believe, right?
Or July, yeah. Then thank you, Rick. Born July 7th.
And mom and baby are doing great, right?
all is well. 10 fingers, 10 toes. Mom and baby are doing great. We're going for the 2-week checkup tomorrow. So, running on fumes a little bit here, but we'll get through it.
Good, good. I'm glad everything's okay, and we'll get by that lack of sleep without a doubt.
It's
Um,
temporary.
it is definitely temporary. And I also want to wish you a happy birthday.
Oh, thank you.
So Saturday's your birthday, so I just wanted to wish you a happy birthday and let everybody know it's Dan's birthday.
Got a lot going on. I tell a lot of people this. We've counted them in our immediate family. Um, you know, uh, my wife, our kids, our brothers and sisters, cousins, nephews and nieces. We have 10 birthdays within 3 weeks of each other, starting with my wife's birthday on June 30th and wrapping up with mine this Saturday. So we've had 10 birthdays over the last 3 weeks.
That's got to make for a great beginning of July,
Exactly.
including the 4th of July. So you add that in. That's a lot
Yeah,
of
we
fun.
all have one big party.
So good, and happy birthday. So I just want to again, thank everybody for joining us today, and I appreciate you joining us in the middle of the summer. I know a lot of people are on vacation, um, and I got to tell you, we had the surprising first half this year. So we're going to cover right now. We're going to cover the incredible first half we've had so far this year. Two conflicting comparisons, which we've been talking about a lot with clients over the last couple of months. There's been, it's hard to make a decision on which way this market's going to go, but we all believe that certain things are going to happen, and we will discuss those further, including an inflation environment that we're in, interest rate environment that we're in, and the potential leading recession that's supposed to be coming up. And then four important charts that we're going to discuss also. And these charts will help define out where we are and why. And we'll probably leave you with a little bit, we won't leave you, but we'll have a lot more questions coming in than we will answers. But we'll try to leave you with some answers that we believe is going to happen towards the end of the year and going into next year. So Dan, why don't you kick it off?
Yeah, and speaking of questions, if anyone does have any, just feel free to use the chat box. We have it open here, so we'll try to get through those questions as we're going through the slides here. So yeah, and as Rick said, little bit of an unexpected start to the year. We actually talked about this last quarter. We started this webinar with I think we pulled up a slide with a lot of green, like every indicator was favorable. The first quarter, the S&P 500 was up. I think it was about 7.5%, and it repeated that performance. So year to date, to close the second quarter, the S&P is actually up 16%. And notably, since the low in October of last year, it is up over 20% at this time, which is the start of the technical start of a new bull market. So just like, a bear market is a 20% correction, a new bull market from a technical perspective is a 20% increase from the low. So certainly something we didn't expect to start the year. We were calling for a flat, if not negative first half followed by potentially a better second half, and the market kind of surprised, I think, a lot of us. The reasons that we're seeing for this are really two pieces. One we've talked about a lot is the Federal Reserve. We're gonna try to lay off the Fed talk this
Oh,
quarter,
that's going to be tough.
but there's still going to be some of that. But the Federal Reserve has curtailed their interest rate increases. They're currently holding at the current level. We'll talk a little bit about it, but the end of that tightening cycle, and probably the more surprising piece is artificial intelligence. So with Chat GPT and Microsoft buying out Chat GPT and some of these other AI applications, a lot of stock investors are excited about that new frontier, and we'll talk a little bit about what that has meant for the market, and that speculation. And that is exactly what it is, because one of the reasons that the market has run up is because of strong fundamentals. We're not seeing expanding profit margins. We're not seeing earnings surprises to the upside. We're not seeing a lot of capital investment activity. We're not seeing favorable interest rate environments, things like that. So the fundamentals of the companies are not strong. Most of this run up has, believe it or not, been speculative, which my guess is that that's probably a surprise to most people listening, because most folks we talk to, and we'll get into this a little bit, don't seem to be as optimistic as the broad market would have you believe. So that's why this is kind of an unexpected start.
That's because a recession's coming, isn't it?
Yeah, well,
everybody knows the recession's coming, Dan. They keep talking about it.
Well, unless you're in a recession's always coming. Question is just when.
I thought it was actually going to be here. Well, I didn't think so, but I hear a lot about it's coming by the end of 2023.
Yeah.
And but actually, it was supposed to come in the first quarter of 2023 when we were talking last year.
Yep.
And now I think the recession's coming in 2024 now, from what I understand.
Well, right, and all the indicators are still there. It just keeps getting pushed out. It just keeps getting pushed down the road, another 6 months, another 12 months. And, we were talking about it. We were talking about it at the end of last year. We're saying the first half of 2023 is going to be difficult. Now maybe it's the second half, maybe it's 2024. So it keeps kind of getting pushed. And the interesting part is, even though everybody's talking about it, there's still all of this speculation, surrounding the AI headlines where multiples are actually expanding. And that's a major reason the market is up so big this year. So we'll touch on that a little bit.
Yeah, because go ahead. I was going to say something. I decided to stop.
So, and in fact, I think maybe what we could do here, let me jump through a little bit. Here we go.
Oh boy.
So talking about that speculation, this is not something that's unfamiliar. The winning strategy of especially the last 10 to 15 years, but really, technically since the dot-com, tech bubble back in the early 2000s and late 90s, the winning strategy has been to load up on American tech stocks, and multiples just keep expanding. One thing that's happened recently here, and the market seems to have an appetite for that right now, is the top 10 stocks in the S&P 500. I don't have the list in front of me, but I'm gonna try to. Do you have it in front of you, Rick?
I got the top 10 right now. I got the top 10 up on the NASDAQ. The top 10 on the S&P 500. You want me to list them real quick?
List them, yeah.
Yeah, so Apple, Microsoft, Amazon, Nvidia.
Yep.
Tesla, Alphabet, Meta, Alphabet C,
yeah,
and Berkshire and United Healthcare are the top 10.
So outside of Berkshire and United Healthcare, these are all tech stocks,
Yep.
right? So weighting of the top 10 stocks in the S&P 500 is at an all-time high. So that means that the 10 largest companies in the US currently have the largest market cap that they've ever had for any of the top 10 stocks throughout, throughout history. 31.7% of the S&P 500 is in those top 10 stocks. Based on, again, we're talking market cap. So stock price times shares outstanding. So when stock price rockets up like that, especially in those top 10 names, Microsoft, I mentioned Microsoft buying ChatGPT. There's a lot of buzz around that. There's tailwinds to some multiple expansion there. It becomes a larger part. The interesting thing though is there's the inverse is happening on the earnings contribution. So the earnings contribution essentially says, okay, well, there's the value of the S&P 500, the total value of the 500 stocks. And then there's the amount of earnings that is generated by those, 500 companies. And you can see, that based on those top 10 names, okay, the amount of earnings coming from the top 10 stocks has plunged. So it's currently at about 21.5%. So we're not talking necessarily about absolute figures. We're talking about directionally. So you have, the market cap based on, essentially price expanding rapidly and earnings contribution declining rapidly. Now, we're not saying earnings are declining, but the point of this is that this is not a fundamentals driven rally. This is a speculative rally.
Yep.
So essentially one of two things have to happen. Either stock investors are proven right and AI truly does revolutionize these businesses, and therefore the earnings will catch up to the prices being paid for Microsoft, Meta, Nvidia, Apple, et cetera, or prices need to correct back down to a level that don't reflect that excessive speculation, right? It's got to be one or the other.
And just to touch on that, Tesla actually came out with earnings last night at the close. And I don't remember where Tesla is right now, but from what I looked at it earlier today, it was down about 14. And right now it's 28. So we're down 28 on Tesla. Yeah. And Tesla, basically they came out with positive earnings. They hit expectation on the earnings. They hit expectation on sales, but their profits were under pressure. And the main reason why their profits were under pressure is because they brought the price of the I think it was the Y and the I can't remember the two different cars that are out there, but they brought the prices of them down, which is actually squeezing out their profit margin. So exactly what you're talking about here, Tesla is actually doing. And Tesla stock was one of the top stocks on that growth chart this year. Yeah. So Tesla has expanded well over from the beginning of this year to date, all the way up to just before it dropped off. It was up over 171% this year.
Yep.
And their earnings or the stock prices moving way faster than the sales actually are and the profits actually are. A lot of this in the story that I read just before, actually, there was a Wall Street Journal article that came out. I think it was the day of or the day before Tesla came out with earnings, and it talked about Nvidia and Tesla's new AI self-drive vehicles, and a lot of that was, a lot of this growth was speculation on this AI, and here Tesla has to reduce the price of their vehicles to be able to keep up with sales margins.
Yeah, and I think the other thing that's important with that to realize, now that's a Tesla specific story, but there is some reality to, if you bring it back to this, you can see with stock prices and market cap, you can kind of see at the top here, if you were to look at the chart of the market, you might say, well, we're not even quite back to our previous high yet. So, prices are just coming back to where they were. But based on the example you gave, Rick, that may be true. But back when inflation wasn't so high, interest rates were lower, and we didn't have some of the issues that we're dealing with. We're talking, late in 2021. So we're talking a year and a half, 2 years ago. Earnings contribution of those companies was much higher. So they had more profits 2 years ago. That is not currently the case. So even though if you look at the price of the stock market and you say, well, we're just kind of getting back to where they were, the issue is that, yeah, but there's no longer the cash flow there. So where's the money going to come from for the investment into those AI projects, which are why investors are paying a higher multiple right now? And in that Tesla example, where they're having to cut the price of those vehicles, and that's denigrating their earnings, that's not a good story. That doesn't paint a very rosy outlook there.
No, it doesn't.
So we'll come back to this a little bit. I do want to touch a bit on, because I think the average average investor isn't really looking specifically at earnings of these individual companies. I think that there are two major comparisons that I want to talk about, which sort of just big picture kind of contradict each other. And one of them is from a broader economic perspective. Essentially, what I would call this is how consumers are feeling about the economy as a whole, because we will prove this out with some actual real data here. But I don't know about you, Rick. Most of my conversations, there's kind of a lingering feeling of pessimism out there.
Absolutely, yeah. And the two that I described in the beginning, I think, is inflation and the question on inflation and whether there's going to be a recession coming up.
Right. So this is what's kind of referred to as the misery index. What it really is the inflation rate plus the unemployment rate. And if you think of it in those terms, high inflation, high unemployment, right? So the higher this number, if you add the two together, the more miserable consumers are. Because, again, if you have a high unemployment rate and high inflation, it's not looking so hot. Inversely, if you have very low inflation and very low a strong labor market, consumers are fairly strong. So over time, this has been a measure that you can trace back to the 1950s. And luckily, we have an idea of where this quote unquote should be. The Fed has an inflation target of 2%. And unemployment is kind of a moving target, but most economists think that it should be somewhere between 3 to 6%. And that's really the Federal Reserve's mandate, is full employment and targeted inflation at 2%. So if you look at these kind of red bars here, ultimately, if the policymakers are doing their job, this quote unquote misery index is acceptable as long as it's within those red bars. And then if it falls below, consumers should feel that the economic conditions are relatively accommodative. And if it goes above that top line, then consumers are likely feeling a little bit more constrained. So look at the spikes, for example, back in the 1970s when we had runaway inflation, you had labor market issues. That's really where this became a popular indicator. And I think one of the important things to realize here is this has been running relatively low, right? Because we've had a fairly strong labor market and no inflation for the better part of 2 to 3 decades now. And you see spikes that even go kind of within the range during some of these recessions, which are the shaded areas. And recently, again, we have a major drop off. Inflation has gotten under control and we still have relatively full employment. So, when you read these headlines and you see inflation and labor market, et cetera, it looks pretty encouraging. The tone of the articles you're going to read is going to be fairly optimistic from an economic perspective because of this index. Essentially, inflation and unemployment both look to be healthy. So when you compare this to the actual feelings of consumers, you get the exact opposite reading, which again is in direct contradiction. So consumer sentiment, which is a poll that's run by the University of Michigan. It's been in place since the 70s. So when you read about consumer sentiment in the news, this is what it's referencing, is this particular survey. So consumer sentiment, I'm going to pull up my reference here. Consumer sentiment is lower than it's been 83% of the time since this poll started in the 1970s. And you can see based on this red line, the only time consumer sentiment has been this low is in the middle of recessions, right? Like you said, Rick, where's the recession? When's it coming? Well, everyone seems to be kind of expecting it. Even though the articles you're reading regarding inflation, regarding the labor market are all overwhelmingly positive on the economy, the actual experience of the consumer appears to be overwhelmingly negative.
So let's go back to those two charts for a second. Go to the first chart that you had, the misery index. Yeah. Basically, what you're saying is that it's acceptable to be between the two red lines according to how people look at this chart.
Correct. Based on the targets of policymakers, correct.
Policymakers, right. But technically, when you're below those red lines, people are generally comfortable with where they are. They're getting what they want. Things are moving along. They're happy. That's what this is giving us at this point, correct?
Correct. Yep.
Okay. So generally, for the last 30 years, people have been generally happy with where things were, even though we've gone through a couple of miserable times back in the 90s, back in the beginning of 2000, and then even going through the financial crisis. And the bottom line with the consumer price or the consumer sentiment, that's basically saying that, once you get below that line, people are fairly miserable, but above that line, people are fairly comfortable with where things are.
The red line is the current reading. So the best way to look at this is, again, you think about, look at where the consumer sentiment has reached the current levels, and it's mostly
during recessions. Yes.
Right. That's how pessimistic the American consumer is nowadays, which is quite I think quite telling, because I can't remember who the quote was, but who this quote was from. It's not mine, but somebody once said that there's no creature quite as resilient as the American consumer. And the fact
that was Warren Buffett.
It may have been. I guess that's probably the best guess for any quote like that. But yeah, I think it's quite telling, because one of the things that you see is every time that a recession is about to happen, all these shaded areas, consumer sentiment starts to drop off right before that recession. And when we talk about the misery index, we're talking about a lagging indicator. We're measuring inflation, 12 months in the rearview mirror, right? We're measuring the unemployment rate at least a month in the rearview mirror. We're not talking about job openings and weekly job reports, right? So consumer sentiment is kind of like the actual experience of consumers, which right now is showing, again, a completely opposed experience to the actual economic data that's coming out. And again, looking back at those previous recessions, Sentiment can tend to be a leading indicator for a couple of reasons. One, because, this is ground zero, right? Consumers are actually experiencing this at the gas pump in the grocery store, whether it's inflation or, in interviews, if it's job market related or what have you, in salary negotiations, blah, blah, blah. But the other thing is, if sentiment is this pessimistic, it kind of becomes a self-fulfilling prophecy, right? Because you have consumers that are kind of expecting a recession. And even though the stock market is saying otherwise, at some point, once you start to see cracks, and the consumer will behave accordingly.
They'll stop buying.
They'll stop buying.
They'll
Right.
stop buying.
So, that's why this is something that we need to pay attention to, even though the articles you're going to read or say, hey, great, we got inflation under control. Hey, great, the labor market, unemployment is at an all-time low. That's all well and good, but I think that the forward-looking, or I should say maybe the current state of the American consumer psyche may be the more important thing to look at right now. So that's one piece that we wanted to take a look at. The second is how the market, so kind of how the investor class, if you will, is viewing, is this a new bull market? Is this a new bear market? And typically the best way to gauge sentiment among investors would be for stock investors, it's something called the VIX, which is simply short for the volatility index. And what we've seen recently is during COVID, starting March 2020, volatility in the stock market, spiked drastically, and kind of remained at elevated levels throughout, and has recently come off quite drastically since we hit that low in October that I referenced. So the current volatility of the stock market is actually back to pre-pandemic levels, and a lot of times this is referred to as the fear gauge. So another way of looking at this is to say stock investors right now are not very fearful of the market outlook, right? Which again is in direct opposition to consumer sentiment. The American consumer is incredibly pessimistic, based on market movements, based on volatility. Stock investors writ large are optimistic. Compare that to the same indicator. This is just a different index, but it does the same thing for the treasury market, so the bond market. Volatility, how fearful are bond investors? And I should have drawn a line through this, but all right, there's your line. Okay. What are the last two times that it reached this level? Recessions, right? We had coming out of the dot-com bubble and the financial crisis. So essentially, bond investors are incredibly fearful, incredibly pessimistic, similar to as pessimistic as they would be during a recession. Stock investors are the exact opposite. So they're showing us completely different things. And basically, the question is, who's right? Because these are not things that are kind of like, middle of the road. Where these forecasts are kind of taken to the extreme. These volatilities are taken to the extreme. It's typically not this opposed. So you would assume stock investors and bond investors are different, but they're typically not on complete opposite pages like this. And I think, Rick, you always talk about the inverted yield curve. That's been a sign, it's been inverted for quite some time.
Inverted yield. Yeah, the
that's
inverted.
been inverted and hasn't led to a recession yet, I think is another thing to realize.
Yeah, it's always predicting a recession. When it's reverted and when it's inverted, it's the market is actually believing that there is a recession coming. And it's very few times has it been inverted that a recession didn't actually hit. But we've been inverted actually since June of last year.
Correct.
And it's a very awkward inversion at this point in time, where the longer term bonds are substantially lower than the shorter term bonds, and inevitably that says there's a recession coming. Um, the interesting part about it is nothing is going to be back to normal until that yield curve normalizes. So
Correct.
everything you're talking about here, Dan, with stock investors and bond investors, is nobody really understands what's going to happen next. They don't understand whether inflation is going to happen, and this is a lot of the conversations I've been having with clients over the last quite a few months. Is the Federal Reserve going to continue? And I know you didn't want to talk about the Federal Reserve today, but is the Federal Reserve going to continue to increase interest rates? And a lot of what the Federal Reserve is continuing to see is inflationary signs. A lot of it coming out of the job market. But what you were talking about earlier, Dan, is when sometimes it takes the consumer's mentality to stop buying. And once the consumer mentality stops buying, then the jobs could potentially fall off. Where typically it's the other way around, is jobs tend to fall off, consumers stop buying.
Yeah.
But again, this yield curve shows a little abnormalcy in this whole process. And go ahead, let's talk about this.
Well, you were bringing up rates. I think that it's still important to realize that the fact that these different that we have all of these, and these are not just I wouldn't say conflicting. These are just completely black and white. Like these are complete opposite sides of the spectrum, but we have these conflicting indicators that we're seeing. Stock investors optimistic, bond investors pessimistic. Economy looks healthy. Consumers are in the doldrums, right? I think one of the major reasons is because there is completely no agreement on where interest rates are going to be even 6 months from now. And that makes it really hard when your benchmark interest rate, this is like finance 101. Whenever you do equations, you always have to know like what's the risk-free interest rate, right? That's always something that you have to understand when you're pricing an asset, right? And this could be a business purchase, or it could just simply be a stock, right? But when we have no idea where interest rates are going to be, and there seems to be no consensus, it's really hard to know, well, what should stocks be worth? What should multiples be? What should our trajectory for earnings growth be? So what we're looking at here is, this is what they call the Fed's dot plot. So each of these dots represents one vote from one of the governors of the Federal Reserve. What this essentially says is that at the end of the year, 2023, 4, 5, if you look at 2023, most of the Federal Reserve Board governors believe that interest rates will be around 5.5, 5.75%. That's what that means, because you see the percentages over here. As you get further out, 1 year, 2 years, long run, they kind of agree, but long run means, 3 years plus. We don't know, and the policymakers are not giving us really any indication of where interest rates are going to be. The only thing we've started seeing is that it seems like every time they meet, you see last and then current. It seems like every time they meet, they're increasing their expectation of where rates are going to be. even though none of them can agree, the consensus seems to be that they're actually trending towards rates are going to remain higher for longer. Even though even though they will come down, they'll remain higher for longer. And what that means is, when you have market participants buying based on an uncertain rate environment, there can be a lot of mistakes made,
So
right?
what
So
you're saying
all that
is that,
speculation that happened in the market, all of a sudden, if capital costs a lot more than you thought it was going to, now that stock price that you paid for Apple doesn't look so attractive.
so what you're saying is the Fed doesn't even know what's going to happen next
Well,
because
right,
they keep raising their consensus.
right, correct. Right. They keep
Interesting.
raising their consensus, and you can see this.
So you wonder why consumer sentiment is down.
Yeah, I mean, you could arguably say there's a consensus for next year, but we're talking, what is that? Six out of the 15, or how many votes? I think they have 16 votes here. 12, 13, 14, 7, 6 out of the 17 votes. So I wouldn't, this is a clear consensus up here. But I think this is a problem. I mean, there's absolutely no consensus on 2025.
But they keep raising their consensus.
But it
So
seems like it keeps
last
trending more in the a little
upside.
bit higher direction, right? But they don't even know. They're kind of like saying, well, look, we have a general idea of where we want to be over the next 6 months. The next 12 to 18, a little bit, but not as much. And 2 years from now, like we have no clue.
Yeah.
So I think the problem with that is, when you have run-ups like this in the stock market, all it's going to take is a surprise in inflation, a surprise in interest rate policy, softening of the labor market, some banking, further banking issues to have that all of that wind that went into the sales of stocks come right back out, right? Because earnings aren't keeping up, and to support those valuations. I think one of the things we talked about last time, just to kind of go into what could break, I don't want to say break the market, but which could create that
Problems.
recession, that correction, what have you, is the banking crisis. Right. We talked about it last time, like we don't think it's over. It's just it's kind of a slow crisis based on what banks have on their balance sheet. And this is what I wanted to call out. And I think you know where I'm going with this, is this. Right. Right there. So this is
So
not 2008, right? The largest banks look well capitalized. So we're talking about small, mid-sized banks.
Yeah. So I think that something like this has happened in the 1980s. And this is actually why they started consolidating banks and making bigger banks, is because as interest rates were going up, we ran into a banking crisis in more of the commercial real estate environment back then.
Right.
And that real estate environment fell apart and actually crushed banks, and more of the local banks. And back then we had community banks. They were predominantly community banks, and they felt that consolidating these community banks and making bigger banks would eliminate this, but it didn't. And with the COVID crisis that we had, what's happening, Dan, I think is with this commercial real estate is there is a couple of things going on, and I can't remember the name of the company that just missed their payments, but it was a bank from Canada that missed their payments. I think it was part of a negotiation tactic. But it was 97 or 87, no, 79% occupied. So the real estate that they actually defaulted on was 79% occupied. So their occupancy was still doing well. But with interest rates going up, they can see into that process. Not only are occupancies doing well, but those that were occupied were actually more like half full. So their concern is with interest rates going up is that they're gonna be paying higher rates, and with leases coming up, they're going to have a reduction in space and occupancy will actually drop off. And seeing that, they're already starting to go through the processes of negotiation, from what I understand and what
Yeah, it
I've read
does.
in the
And
past.
to that point, it doesn't always mean that like, oh, there's going to be defaults where cash dries up and it hits the banks. But and obviously commercial doesn't mean, we're really the thing we would be more concerned about would be like office space, right? Industrial isn't as big of an issue. But office space would be. But think about it, we're sitting here, it's July 2023. The pandemic started March 2020, and most office space leases are 3, 5, 7 years.
Yeah, 5 to 7 years.
So this is just the beginning. And the question is, do you have a bank, a smaller mid-sized bank, who finance these properties, and they have they have an exposure to much more office space and potentially companies that aren't using it than bank A versus bank B, right? So the question is, and we don't know the answer here, because these are not necessarily things that are easy to know if you're not actually on the inside. But the question here is who made those bad bets? And again, it's not that they would have known that back in 2018 or whenever they made those investments, but who made those bets where they are overexposed to office in a particular industry, and that's going to create defaults. And depending on the health of their balance sheet and how those two things, come together, this is more than likely to be sort of the next shoe that drops on the banking crisis, simply because, again, small to mid-sized banks have when you look at their asset exposure here, I mean, the one thing that jumps out is, wow, small to mid-sized banks have a huge exposure to commercial real estate. Some of them are going to be diversified and well managed. Some of them are going to be well capitalized. It doesn't mean that this is going to spill over into the entire system, but it is likely that at some point we're going to see more stress in the banking system. And the guess would be is that this is where the kind of whole issue with office space is going to actually come to a head, right?
Yeah.
Because
So
you have these banks that are going to be overexposed to it.
So we could potentially bring this, or the Fed could potentially bring this economy into a soft landing, but where the risk lies is behind the real estate market, the commercial real estate market, and
Yeah,
especially office space.
yeah, I would say that's from the banking side at least, definitely true. And I think the last thing that we wanted to cover here, and then we can open up for questions. We got about 15 minutes here, so we'll spend 5 minutes to this. I actually think this one is the most telling.
This is one of my favorite charts here.
Yeah. I have a hard time getting past this because, and there's an easy way to explain this. Essentially, the banks are much less willing to lend. I think, Rick, you had a comment on that. And businesses are much less willing to borrow. But I think that it's important that we kind of explain the intricacies of these charts, because it is a stark drop off in demand, which I think is honestly the biggest issue. But the tightening credit standards is, we've known about that just because interest rates have been going up. But it's becoming more stringent in terms of what banks will give out loans for, or if they're going to at all.
Yeah. I was actually talking to a guy, he's an insider, and I'm not going to mention the bank, but he was an insider, and the bank was literally telling their lenders not to lend money. Just sit back and stop pursuing the lending of money, which I found that very interesting.
Right.
My question was, how are they going to meet their goals if they're not lending money? But
Yeah,
that's
they're going to invest in the office space. Uh,
so
yeah.
no. But and I think what you were talking about earlier, Dan, when we were discussing some of these factors, is businesses just don't want to borrow right now.
Yes.
They're also in a position where they're holding back and they're not interested in borrowing right now until things settle down.
Right. So I think this is a really important point here. So you could look at that and say, well, of course they don't want to. Interest rates have gone up by 500 basis points over the last year, right? And here's the thing. So I'm going to try to draw a line here. All right. So this top chart, banks less willing to lend. Credit standards have been tightening over the past 2 years. You can see this is going up, right? So that going up means it's essentially harder to get a loan, tighter credit standards. If you look at the bottom chart, whether or not businesses, corporations want the loans, it has continued to go up, even though rates are going up, and even though credit standards were tightening. Businesses still wanted the money. I think what's interesting is, and there doesn't seem to be any tricky math here necessarily, but the demand for loans hit sort of an inflection point right here. I would say, I guess it was early to mid 2023 at this point in time, hit an inflection point, and it has just kind of fallen through the floor. So the demand for loans in small to mid-sized businesses, sorry, I should say from small firms to large firms. If you draw a line here, again, is currently back at like recession levels. So the last time that it was this low, the demand for loans was this low, we were either in the financial crisis or we're in the dot-com bubble burst. And basically what that means when you think about the demand for loans, it's one of two things is happening. Either businesses are going somewhere else other than banks to get the capital they need to invest in their new projects or their workforce or whatever they're investing in. Or they're not planning as much capital expenditure. And from what we understand, it is more the latter than the former, meaning it's not like the market for capital investment in businesses is now being met through private credit or business development companies, or they're going to invest their own cash that they have sitting on the sidelines, or they're going to do like some equity raise. Most there's part of it will be used from those sources, but the vast majority of the drop off in demand for loans from banks is coming because businesses are not planning to have capital investment nearly as high as it has been over the past 10 to 15 years. And that right there, I think, is the most telling sign to say, well, stock investors are speculating that AI is going to revolutionize business. And so they're buying up the market. Okay, great. But then that actually has to happen for it to be worth those prices. And if the capital expenditures that businesses are currently planning is falling through the floor, there's no money going into it. There's no money going into it. So I think that there's a better case for prices catching down than profits catching up, because I just don't see how profits can catch up when you don't have nearly as much capital investment, as you have over the last 10 to 15 years.
Yeah. And And I think that makes a lot of sense. Actually, Morgan Stanley came out with when lower than expected earnings the other day as well, and the main reasoning for lower than expected earnings is the lack of deal making.
Right.
So
Exactly. That's exactly.
mergers and acquisitions aren't happening. Lending through credit sources within Morgan Stanley and a lot of other brokerage firms like that are slowing way down. So if that is happening, um, if lending isn't happening and and businesses aren't, or if private equity isn't getting involved, if deal making isn't happening, um, then ultimately the investment can't happen as well as what you're saying. But at the same time, a lot of this investment happens from small companies, correct? A lot of
Yeah.
the smaller companies, the mid cap companies, tend to be the ones making these investments. A lot of the deal making tends to come from the larger companies like Microsoft buying out Chat GPT. Um, that tends to happen from the bigger companies to the smaller companies. A lot of that has slowed down.
Hmm.
Um,
I don't have that on this chart, but yeah, you're right.
yeah, no, I know you don't have that on that chart, but it's the deal making you didn't. I just came up with that because of the
Yeah.
because of Morgan Stanley producing lower earnings, lower than expected earnings. And a lot of that has to do with what you're talking about here is that if companies aren't borrowing, banks aren't lending, and deals aren't happening. And I actually got a question here that if banks are not lending and businesses are not borrowing, wouldn't that put us into a recession? You can go ahead and answer that question. I got some comments after, Dan.
Um, yeah, I would say that not necessarily as a rule, um, that it would put us into a recession. The reason that I would make the argument that it will is that there are too many, as I mentioned, there's with the kind of competing indicators. Um, is that I think there are some market participants that are kind of too far out over their skis, and they are trading on speculation, and there is no fundamental backing to that speculation. So again, the point would be, look, if the market didn't run up quite as much, and then the deal making fell off, and loans fell off, you know, it wouldn't necessarily mean that there's going to be a recession or a market correction. But when you have a run up of speculation and then you have nothing to back it up, that's what gives me pause to say, like, this has got to be fleeting. This has got to be fleeting. I think that what this is more likely to do from a recessionary standpoint is if there's less money going into capital expenditures, that's saying that businesses are tightening up their belt, and they're seeing internally that earnings are being, to your point with JP Morgan, are being revised down. So how long does it take for that to bleed into the labor market and actually create a recession? Right. I don't think it, as a rule, means we're going to be in a recession, but it's certainly not a good outlook.
Yeah. And I would add to that in the fact that I agree. I don't think it necessarily will cause a recession, but I think it sets the stage for a very slow growth environment moving forward.
Yeah, and so that I'm gonna just pop this. If anybody does have questions, just pop them. You can continue to pop them in the chat box here. But that's another. This is really the reason why we've continued to, um, uh, you know, stay focused on fundamentals, stay focused on quality stocks, um, and not get caught up in benchmarking to when the broad market does something that in our estimation, quite frankly, just doesn't make a whole lot of sense. um, so we believe that sticking to strong fundamental companies is still the appropriate strategy in this market. we think it will continue to be for quite some time, because this is sort of a new market regime where we're not going to be back at the zero interest rates that we've been at for the last 20 years.
Right. And yeah, and I don't believe, even though, even if we do have a recessionary environment, I do believe that, well, that interest rates won't go back to zero, won't even go to 2% as the Federal Reserve seem to be indicating at that point, at 2025. I do believe we're on a longer trend upwards. So although we will go back eventually, we won't go back quite as low as where we were. But I do believe that trend could potentially be on an upward level for the next 15, 20, or 30 years.
Yeah, well, it's going to have to be. That's how it works.
So was there another question that we had up here? I think we answered that one already. So with investing like we are now, we continue to focus on dividend stocks. If we are in a longer term inflationary environment where inflation tends to stay above the 3% level, we believe those dividend stocks will continue to give us increasing income as time goes on, because the dividend stocks we continue to look at are dividend stocks that have a habit of increasing their dividends on an annual basis. And the other thing comes into play, Dan, is when clients are talking about inflation and concerns about recession and volatility in the market. And that was the other question that I did see pop up was, could this market go down aggressively if we do hit a recession? And I don't necessarily see the market going down aggressively, at least where it was back in October. We can have some downside volatility, but I do see that the market can drop off a bit. And we don't have as much where we are today with a lot of what you were talking about then with AI, with the run up of the market, the surprise that we had, which we're actually over right now on a year-to-date basis. We're over 18% on the S&P 500, and the NASDAQ we're over 35% for the year on a year-to-date.
Right.
And I don't necessarily see that dropping off aggressively, but we don't see a lot of growth in front of us either. And I think that if where we are with interest rates and with short-term bonds and short-term interest rates, I do see opportunity being able to be captured in that short-term bond market, where we can get 5.25% in CDs. Why take the risk if we're getting continued volatility? So, continue to get that 5.25%, continue to focus on that dividend portfolio, continue to focus on high quality stocks, I think is where we want to continue to move forward. Any other thoughts to that, Dan?
No, I think it's just as it's always been. It's you can't time these things perfectly. And even though I think if you listen to this whole webinar, you probably say the general tone of it is pessimistic.
No.
But I would say that even though that maybe there's sort of a broad expectation that a recession has got to be around the corner, the issue with only focusing on that and only focusing, for example, on, why wouldn't we just get 5% in a CD? We want to continue to have strong dividend stocks. We want to stay diversified, because the timing is the one thing that's impossible. Timing is the one thing that's impossible. We've been talking similar to this for quite a while now. But we're trying to adhere to those broad themes that we believe are going to serve portfolios well, over the next year, 3 years, 5 years. And it is a strong, you're right, it's a strong focus on fundamentals. It's take that 5% in those CDs when you can get it. Keep the dividend yielding stocks in the portfolio. Don't chase growth right now. does not seem to be it seems to be a too volatile of a strategy. Now for long-term money, that's fine. But if we're talking about, retirement income portfolios, things of that nature, we have to make sure that we're adhering to uh, a more principled and fundamental approach to the portfolios.
Yeah, and I would add to that just one more thing before we exit, is don't chase aggressive growth.
Yeah.
I think as long as we stick with good quality growth stocks that have good, strong fundamentals, good, strong cash flows, not extraordinary debt, and a good focus in this market where they can handle ups and downs and a recession and a potential recession, I think those companies also will continue to do fairly well.
Yep. No, agreed.
So,
Well,
Dan, thanks for all your information and a lot of what you put into this. I know Dan puts a lot of effort into the letter that goes out to clients on a quarterly basis, and he puts a lot of effort into this this program as well. And I appreciate your effort that you put into this, Dan, especially with your circumstances now with a new baby that just came along, and you continue to put a lot of thought into this whole process and the letter and the program that we have today. So thank you for
appreciate
participating
that.
and doing that.
Got to keep the finger on the pulse. So
Absolutely.
thank you too, and thank everybody for attending. And yeah, we'll see you next quarter.
Have a great quarter.
All right, see you.